Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, we knew April 2nd was going to be big, but did anyone expect this?
Honestly, not to this scale. What President Trump unveiled this week isn't just a policy pivot, it's an economic earthquake. A blanket 10% tariff on all imports, plus eye-watering rates like 34% on China, 24% on Japan, 32% on Taiwan, and 25% on all foreign-made cars. Markets are calling it what it is, a 1930s moment. The S&P 500 took a hit, futures slumped, and the global economy is suddenly trying to reprice everything: growth expectations, inflation, trade flows, and political risk.
Let's break that down. What are the real economic consequences of this move?
This is the largest effective tax hike since 1968. If fully implemented, it's nearly $400 billion in extra costs, 1.3% of US GDP, but more importantly, it's inflationary. JP Morgan estimates the tariffs could lift core PCE inflation by 1% to 1.5% this year. That puts real disposable incomes under pressure and raises the specter of a shallow recession, especially when 70% of US GDP is driven by consumption. Add in retaliation from Europe, China, and others, and suddenly global trade starts to shrink, not expand.
So is this the beginning of stagflation?
It's starting to look that way. We've got inflation risks rising, growth slowing, and central banks stuck in the middle. Bond yields are swinging wildly. The 10-year U.S. yield dropped to 4.05% as investors fled to safety. But if inflation sticks, those yields could easily bounce toward 5%. Meanwhile, corporate high-yield debt is underperforming, credit risk is building, and supply chains are being thrown into disarray.
And what about equities? It seems like the tech shine has worn off.
Exactly. The U.S. equity market has now unwound nearly all of its outperformance from 2024. The Magnificent Seven now match the Chinese equity index. Think about that. We're also seeing strategic paralysis from corporates. How do you plan a 5-year supply chain when the rules can change overnight? Some companies will try to pivot sourcing to alternative markets, but that takes time, money, and brings operational risk.
Any safe havens left?
Gold. It's quietly hitting new all-time highs, now north of $3,000 an ounce. It's doing exactly what it's supposed to, protecting against chaos. It's not just retail flows, it's central banks and institutional money looking for certainty. Utilities and energy are also hanging in, especially as geopolitical tensions rise. But the rest of the market? It's going to need policy support. Fast.
Final thought, what's your advice to investors right now?
Stay nimble. We've entered a new regime, more protectionism, more policy unpredictability, and higher inflation risks. Diversify across real assets. Watch the bond market like a hawk. And don't underestimate gold. It's sending a message. Oh, and one more thing. This is just the first volley. Retaliation is coming. So buckle up.
That's it for this week. Stay tuned for more insights next time.